What we're going to be going over here is post-retirement benefits accounting. Now, post-retirement benefits accounting is very similar here to pension accounting, but when you're doing your accounting here and you have both a pension plan here and you also offer post benefits like hospital insurance and that to the retirees, you want to keep those separate here. So post-retirement benefits accounting would be separated here from pension accounting, but our accounts and our journal entries are very similar. Okay, so what we're going to start it with is a very basic example here, and we'll start with we're going to look at our various accounts here, but we're going to start with first this post-retirement. That's the annual expense for the post-retirement benefits here, and let's see what it's composed of, and let's just go in by our definition here and see what's going on. Okay, so what I'm showing here, I've got some figures showing here. This is typically what's included in our expense account here for post-retirement benefits here. So what we're going to have here is I'm showing it in thousands of dollars, and then for our debits and credits here, I've marked them with letters A, B, C, and D, and so forth here, so you can cross-reference your different accounts here to see where they go in. Okay, so let's look at our expenses here for the post-retirement benefits. And first, let's go by definition and see what they are here. So first off, let's start with what would be included here. So we would start with our service cost here. Now that would be an increase in our post-retirement benefits payable. And that would be the present value of new benefits earned. I'm showing it as A item here, and that would be what we show as a service cost here, and I'm debiting in this case for $90,000 or $90,000 to say here. And then secondly here we got what we call interest costs. I got $68,400 in interest costs. So what would that be here? That would be the interest expense accrued each year on a discounted basis for our post-retirement benefits. So you can go and see what the definition on that is. So, but anyway, our interest cost in this case, again, it increases our post-retirement expense account here, our annual expense account here, and that we can just look at it in this example. The interest cost is really the post-retirement benefits obligation at the beginning of the year, whatever that amount is, and I'm showing 760, or we'll see it's 760,000 times the discount interest rate. In this case, I'm just showing 9%. So 9% of the 760,000 is going to give us an interest cost here of $68,400. So that again increases our post-retirement expense account. And then we can go in here and we have what we call the return on the plan assets, and we would be looking at our actual return here versus our expected return. And for our example, it's going to be the same here. The actual return that we have on the plan assets is same as the expected return. Therefore, we're not going to have to deal with any gains or losses in this example. To look at gains and losses, you can go to pension accounting and see how you handle the pension annual expense here. But we're just going to deal with where the actual return equals the expected return here. So in this case, we always reduce our post-retirement expense here by the amount of the expected return. If we got any gains or losses, we account for those separately here. So we credit or reduce our post-retirement expense here by $62,000 in this example. So let's go down and look at what we're talking about here for the actual return. That's on our plan assets here. Now that would be the interest and dividends that accumulate within the fund here, any increases or decreases in the market value that we have in any stocks and bonds or whatever we're holding in this fund here. So here's take your return here on your investment or the expected return, credit or reduce your post-retirement expense by whatever that amount is. And then finally here we have some amortization of prior service costs. So in this case we debit, or we're going to increase our post-retirement expense in this case by 3 here or 3,000 here. And let's look at that, what this amortization is here. So the amortization of our prior service cost, that would be an increase or a decrease in benefits for the employee service provided in prior years. And it's really retroactive benefits for post-retirement expense in the future here. So we've got, I'm showing that here. And then one other last thing we would have here are gains and losses. Those are changes in the post-retirement benefit obligation and changes in assumption based on actual returns versus expected returns. And for our example here, we can go back up to it and look at it. Our actual return here is going to be the same as the expected return on our plan assets, so we're not going to have any gains and losses. But what we want to do in each of our accounts here, what we want to do is we want to look at just what we'd have for the year here. In year X1, what we would our debits and our credits here, what our balance would be here, in this case the post-retirement annual expense here. So we would have had our debits amounts here, and would have increased our post-retirement expense, and then our credit amount here for the return on the return on our investment here reduced our post-retirement expense, and then we had some amortization here which increased it. So the total amount here for the year, that net amount in our post-retirement expense account here is $99,400 or 99.4. And this is important to note here because this is what we're going to use for our journal entries here at the end of the year here. And then let's move over to our next account here. And then first off, this post-retirement, that's an expense account that we would include here on our income statement. But moving over to our cash account here, for that's contributions that we're making to the post-retirement account here for our plan assets here on post-retirement. And that we would just show, I'm just showing here as a credit or reduction to our cash account here. That's the contribution made to the plan assets, and that would have been a credit here, reduce our cash here by $56,000. So the total amount here in our cash account for our post-retirement contribution here, credit or reduce cash here for the year by $56,000. Now let's move over to this other account here. We've got this. When we're dealing with this post-retirement benefits, and the same for pension benefits here, we have to be using an account here called Other Comprehensive Income, and I'm showing it here for the prior service cost here. Now that's an equity account here on the balance sheet here, but in our example, we're only going to be looking at our prior service costs here for Other Comprehensive Income. But if we're dealing with any gains or losses here on our post-retirement account here, we'd be using another account here called Other Comprehensive Income, and it would be separated out here for gains and losses. It would be separate here from our prior service cost, just to make that point here. Okay, so let's go back to our Other Comprehensive Income, prior service costs. So what do we have in this case here? Well, the only thing we had was the amortization of our prior service cost for our post-retirement annual expense. So what we had there, we had a debit to our post-retirement annual expense here. Now we would credit or increase Other Comprehensive Income, our equity account here, by the $3,000 here. That was the amortization of the prior service cost. So what we would have for our year here under Other Comprehensive Income for a prior service cost, we just had a net amount here, a credit, or we increased it here by $3,000 or $3 here for the amortization of the prior service cost. Now, the key thing is here, that's for what our entry here for year X1 we're looking at. But what we want to do is we have to look at the beginning balance, whatever we had in that account, to know what we're keeping here in the Other Comprehensive Income, or what the accumulated amount here is in the Other Comprehensive Income. The Other Comprehensive Income accounts here, they're cumulative type accounts. So just say at the beginning of the year here we had 100 or 100,000 or a reduction to our Other Comprehensive Income, and so for the year here we had a credit of 3,000 or 3 here, so the net amount would be a reduction to our other debit or a reduction to our Other Comprehensive Income here by 97 or 97,000 here. Okay, so the key here is this Other Comprehensive Income. We set it up for our prior service cost. Again, that's an equity account here on the balance sheet. And if we have any gains and losses, which we're not looking at in this example here, we'd have to set up a separate account here for Other Comprehensive Income, and that would be for any gains or losses. I'm just showing the prior service cost here in this example. And then let's move over to our fourth account here that we have for our journal entries, and that's going to be, we have to set it up here for the post-retirement asset and liability, whatever is changing here in our post-retirement account. And we'll look at it here again on our balance sheet here for any asset or liability account. Now this account here is tied into the post-retirement expense, our cash, the Other Comprehensive Income accounts for prior service costs, and also our gains and losses. And this is going to be one of our accounts that we use for our journal entries at the end of the year here. But let's see how it's tied into. We've got these other accounts here. Let's move over to them. And now these are the main accounts that we keep our balances in our post-retirement benefits here. And we call it a post-retirement benefit obligation here. These are memo accounts, and we also have our plan assets for our memo accounts. And this is where we maintain our balances here in our accounts here for the post-retirement benefits and the assets that this post-retirement is maintaining here. So let's first off look at the post-retirement benefit here. Now, what is that? That's a post-retirement benefit obligation. That's the present value of the vested and the non-vested benefits accrued to date. So this is where we're going to keep this post-retirement benefit obligation. That's a liability account, and that's where we keep we keep track of the benefits, the post-retirement benefits. We keep track of it in this account here. And then our plan assets, those would be our investments in our stocks and bonds that we're holding here for the post-retirement benefits. So these two accounts here are really memo accounts, and they don't become part of the journal entries here when we're making our year-end journal entries. So let's go back to this post-retirement asset and liability account and look at what's going on here. So what we would do is we're going to start out with a beginning balance here, year X1 here, the beginning of the year. We have to know what we're starting with here. So we're going to have a credit or reduction in our asset account or an increase in our liability account here for this post-retirement, for our post-retirement benefits accounting here. So how do we get the credit or reduction here of 50? Well, what you have to do is you have to know what's going on in your PBO obligation account here, a post-retirement benefit obligation, and you look at your beginning balance. In this case, we had a credit of $760,000 or $760,000, and then you have to also know what's going on in your plan assets. You have to look at the beginning balance in that. So now our beginning balance in our plan assets, we have $710,000 or $710,000. So just make your comparison here. You can see your liability of $760,000 here for the benefit obligations here is greater than the assets that you're holding here of $710,000. So that's going to give us a credit or reduction in our assets or an increase of our liability by $50,000. Simply the difference between $760,000 and $710,000. But let's go down and let's look at our guidelines here. So this post-retirement benefit obligation, these are the guidelines that we use here to determine if we got an asset or a liability. So if the PBO here is less than your plan assets, then you have a post-retirement asset. That would increase your post-retirement account here. But if the PBO here is less than your plan assets. Now, if the PBO or the post-retirement benefit obligation here is greater than the plan assets, then you would have a post-retirement liability here. So again, if the assets here, in our case here, the PBO or the post-retirement benefit obligation here was greater than our plan assets, that gave us a liability amount. So that was the guideline. Now, if the opposite were true, if our plan assets here were greater than our post-retirement benefit here, then we would have a post-retirement asset or increase our post-retirement asset by that amount. But what you want to do here is you have to determine what your ending amount would be for your post-retirement asset or a liability, whatever your ending amount is here, and then you have to come up with any debit or credit to get from whatever you have in your beginning amount in this post-retirement asset and liability account to whatever you need here in the ending amount for your post-retirement account here. So let's look at how we're going to get this here. So for year X1, we're actually going to have a credit or reduction in our post-retirement asset by $40,400 here. So we need at the end here, we're going to look at how we got to the $90,400 here, but we need the $40,400 because we started out with a beginning amount here of $50,000 or $50,000. So sum total here of credits or reduction in our post-retirement asset account here was the $40,000 here was a balance between our beginning amount here, $50,000, and what we had here at the end of $90,400. So how do we get our ending amount here, $90,400? So here's where we move over to our PBO liability account here in our plan assets. So this is what you have to do. You have to let's look at our PBO here. Our beginning amount here we had at $760,000 here a credit. Then we had the service cost that increased our post-retirement or PBO here by $90,000 because that was a debit to our post-retirement expense account, so we credit our post-retirement obligation by that amount here, $90,000 for the balance. And then our interest cost, remember, that was a debit to our post-retirement expense here of $68,400, so our credit goes to our PBO amount by $68,400. And then the other thing that we would have for our post-retirement benefit obligation, say we paid 40,000 payments to the retirees here, so we debit or reduce our liability by those payment amounts of 40,000. So then we net out our credits with our debit amount here. So the end of the year here, our balance sitting in our post-retirement obligation is $878,400 here. Now, moving over to our plan assets. Remember, we started out with our beginning amount here, $710,000. Now, this is where then we debit or increase our plan assets for the return we had on the investment. Now, our actual return equaled our expected return, and that was $62,000, so we debit our plan assets by $62,000. Remember, that was a reduction or a credit to the post-retirement expense account. And then the other thing was that cash contribution. Remember, that was a credit to our cash, or reduced our cash by $56,000. Now we debit or increase our plan assets for the contribution amount here of $56,000. So those are our debit amounts. Now we have our credit, or we reduce our plan assets here by the amount of that benefits paid to the retirees. So in this case, we credit our plan assets by $40,000 here. So netting our debits against our credits here, our ending balance is going to be $788,000 here for our plan assets. So again, this is where we come into those guidelines here. We're going to compare our PBO, or post-retirement benefit obligation, with the plan asset amount here. And this is going to give us post-retirement, in this case, a liability or reduction on our post-retirement asset account here, and increases the liability to $90,400, the difference here. So again, we go through these guidelines here to determine if you've got an asset or liability balance here at the end of the year here. Again, look at your PBO. If it's less than the plan assets, then you're going to have a post-retirement asset increase for the end of the year here. Or if the PBO here is greater than the plan assets, then you're going to have a post-retirement liability. So in this case, the PBO here was of $878,400 was greater than the plan assets of $788,000. Therefore, that set up a post-retirement liability amount here, difference of $90,400. So then you can see where that's how we got the ending amount. We determined what our beginning amount was, simply in the same fashion, the difference between post-retirement obligation and the plan assets based on our guidelines here. And in this case, we had a credit or reduction to our post-retirement asset account here, or increase in our liability of $50,000, ending amount $90,400. So that gave us the plug here of $40,400. What we needed for our increase in our post-retirement asset and liability account. Now, the other way we could look at it is this here. This is really, you have to look at it in this way too here, to make cross-check and make sure all your debits and credits are correctly. So if you look at your post-retirement expense for the year, we had $99,400. That was a debit amount here. And then our cash funding, we had a credit of $56,000 here for the year. We reduced our cash by $56,000. And then our amortization for the prior service cost, we increased that. We had a credit here of $3,000. So what we would do here, again, it becomes a plug here for our post-retirement, in this case, asset or liability, and it actually became a liability here. So the credit of we came up with a credit here of $40,400, and that's simply where we had our debit amount here for the post-retirement expense of $99,400, and then we had these two other credit, and then that was our debit amount here, and then we had, knowing our cash funding, we had a credit amount here, $56,000, and then our amortization of prior service cost here, credit of $3,000. So adding our credits and comparing it to our debits, it becomes a plug. We needed the $40,400 here for a credit in our post-retirement liability. Okay, that's how you determine whether or not you're going to have an increase in your post-retirement asset or a reduction in your asset, and you have an increase here in your post-retirement liability account. Okay, All right, we've taken care of that here. Now let's just go down and let's look at how we'd record this here. And those were those 4 accounts that we were talking about here for looking at how we'd record it here for the year. Now, what you're going to note is the post-retirement benefit obligation account and our plan assets aren't showing in our debits and credits here. Those are separate, just maintaining our balances for our liability and our asset on this pension, on this post-retirement accounting here. So we would take our post-retirement expense amount, we debit that here for $99,400, and then we would credit our post-retirement asset or liability account. In this case, I'm just saying it's a liability. We credit that here for the $40,400 that we had up here, and then our other comprehensive income for the prior service costs, we would have credited that here for $3,000, and then our cash funding, we would have credited that here for $56,000. So our debit here of our post-retirement expense balances with the credits here for our post-retirement liability, asset and liability account. In this case, it was a liability. Our other comprehensive income for our prior service cost here, and our cash funding for funding our plan assets here. Okay, so that takes care of it here. So just in our basic example, and what we want to really get out of this here is that, let's move up to our account here. Let's just say our accounts here, remember when we were going through it, if you look at pension accounting, really what we've done here is for our post-retirement benefits, you keep them separate. Anything you have in your benefits separate from your pension, whatever you'd have in your pension accounting. So these benefits here, that would be like extra hospitalization insurance offered to the retirees and so forth here. So everything is kept separate here. But where we would have had pension asset or liability, in this case we just put in a post-retirement asset and liability account. We maintain it the same as pension accounting, only though it's separated here, and then you would do the same. You'd have the same type of accounts, only that you'd use post-retirement here versus pension accounting. And then you're doing the same here for your post-retirement expenses here. But what you want to do is you've got these 4 accounts here, and for the post-retirement annual expense, your cash contributions, your other comprehensive income, and for prior service cost, and you also have, we could have set it up other comprehensive income for gains and losses, but we didn't have any in this example. We didn't go into any gains and losses here, but that's what you'd have to do here. But the key thing here is you want to maintain your balances here in this post-retirement accounting here for your PBO obligation or your liability account here, and then you'd have your plan assets as your asset account. And you can match up all your debits and credits that I'm showing in this example. But this is basic example here on post-retirement benefits accounting. Okay, so that'll take care of our discussion.